Welcome to This Explainer. Today, we're diving into a really fascinating paradox surrounding one of America's oldest automakers. If you're an investor, or honestly, even just someone watching the completely chaotic auto market right now, this is a masterclass in how scary headlines can completely mask financial reality. Because, if you've been reading the news over the last couple of years, you'd probably think the legacy auto industry was in a total downward spiral. But when we actually look at the underlying financials, a completely different, much more lucrative story emerges. So let's dive into this massive question. With the electric vehicle market in absolute turmoil, consumer demand fluctuating wildly, and EV startups literally burning through cash just to keep the lights on, how on earth did General Motors manage to pull off such a massive rally? I mean, over the past 2 years, their stock has essentially doubled. It almost defies logic when you listen to the broader industry narrative. To put this into a sharper perspective, GM stock gained over 50% last year alone. They didn't just survive the so-called EV winter, they drastically outperformed the broader market and left legacy Detroit rivals completely in the dust. So today, we are going to unpack the exact capital allocation formula Mary Barra and her management team used to achieve this. Here is our roadmap for the analysis. 1. Navigating the EV headwinds. 2. The Cruise restructuring. 3. The ICE profit engine. 4. A cash flow powerhouse. And 5. The 2026 road ahead. Section 1. Navigating the EV headwinds, the cost of transition. You really can't understand GM's current runaway success without first acknowledging the serious pain they went through in 2025. In the fourth quarter of 2025, GM took a massive $7.2 billion hit in special charges. Now, this wasn't just some minor accounting adjustment. This was a heavy structural blow tied primarily to a drastic pullback in their electric vehicle operations, as well as a major restructuring in China where they've been losing market share to hyper-competitive local brands. The financial fallout from those charges was severe. Full-year net income absolutely plummeted by 55%, dropping down to $2.7 billion. A huge chunk of this came from canceling EV supplier contracts. These were suppliers who had geared up for high volumes that, frankly, simply didn't materialize once consumer demand faded. It was a painful, rip-the-Band-Aid-off moment for management, but it was absolutely necessary to right-size their capacity and stop the bleeding. Section 2. The Cruise restructuring, refocusing autonomy. Because EVs weren't the only futuristic venture getting a harsh reality check. GM's autonomous driving unit, Cruise, also went under the microscope as part of this massive financial cleanup. GM moved to acquire the remaining shares of Cruise, bringing their ownership to over 97%. But the real headline here is that they are completely refocusing the unit's operations away from hyper-expensive experimental projects and back toward personal vehicles. The ultimate goal is to slash Cruise's cash burn by more than $1 billion annually, starting in the first half of 2025. It's a brilliant strategic pivot. On one hand, they're playing hardcore defense by right-sizing their EV ambitions and ruthlessly cutting Cruise costs. And on the other hand, they are playing pure offense by redirecting all that freed-up capital straight into ramping up their high-margin internal combustion engine trucks and SUVs. They stopped chasing the hype and doubled down on what actually makes them money right now. Section 3. The ICE profit engine, trucks, and SUVs lead. And that brings us to the core economic engine that is single-handedly saving the day for General Motors. Despite all the nonstop media buzz focusing on technology, AI, and electrification, GM's incredibly resilient consumer demand for traditional gas-powered vehicles right here in North America is an absolute juggernaut. It's the rock-solid financial bedrock of the entire corporation. When you break down the numbers, General Motors North America accounted for a staggering 83.5% of their $185 billion in total revenue for 2025. That is over $154 billion coming from this single segment, completely dwarfing their international sales and Cruise operations. North America is literally carrying the company on its back. And that incredible momentum, it's rolling right into 2026. GM reclaimed the absolute #1 spot in Q2 U.S. sales, moving almost 715,000 vehicles. And they're doing it with record-breaking demand. We are talking about the best-ever Q2 sales for the GMC Sierra pickup, the best Q2 ever for Chevy's SUV lineup with the Trailblazer up 28%, and the Buick Envista posting its best quarter ever. They are ruthlessly executing on selling exactly what American consumers want to buy.
Section 4. A cash flow powerhouse. Rewarding shareholders.
So, the crucial question for any investor is what exactly is GM's management doing with all this truck and SUV profit, and how did it double the stock? Well, they are aggressively and relentlessly rewarding their shareholders. Following a previous massive buyback, the board just authorized a brand new $6 billion share buyback program. When a company buys back its own stock at this scale, it reduces the total number of shares available, which inherently makes your remaining shares significantly more valuable. But wait, they didn't stop there. They followed up that huge buyback announcement immediately by hiking their quarterly common stock dividend by 3 cents to 18 cents per share. That's a massive 20% increase in their dividend payout. That sends an undeniable signal of extreme confidence in their cash flow generation straight to Wall Street. This is absolute music to a value investor's ears. It is capital discipline in action. They expect to generate up to $11 billion in adjusted free cash flow this year. Because they were trading at a remarkably low forward price-to-earnings ratio of just 6.73x, they've been scooping up their own stock at deeply depressed valuations. Since late 2023, they have repurchased $23 billion in shares, reducing their total outstanding share count by an astonishing 35%. That right there is the textbook definition of how you drive shareholder value in a mature industry.
Section 5. The 2026 Road Ahead. Upgraded guidance.
Based on an incredibly strong first quarter, GM actually went ahead and raised its full year 2026 adjusted EBIT guidance. They are now targeting a midpoint of $14.5 billion, which is up from their previous estimates, and they bumped their earnings per share guidance right alongside it. They are easily and consistently surpassing Wall Street's expectations. Plus, they are getting some serious help from the macro environment right now. GM is benefiting from a recent rollback in environmental regulations, meaning they will save up to $750 million by simply not having to purchase EV credits from competitors to meet efficiency standards. Add to that a favorable Supreme Court ruling regarding the International Emergency Economic Powers Act, which resulted in a $500 million favorable adjustment on tariffs. These are massive external financial tailwinds padding their bottom line.
Duncan Aldred, the president of GM North America, really hit the nail on the head here. He noted, "Our business is performing well, and customer demand is resilient, especially for our trucks and SUVs." And it's so true. Despite all the noise, all the mandates, and all the futuristic forecasting, GM's core business of manufacturing and selling gas-powered vehicles is healthier and way more profitable than ever.
Which leaves us with this final thought to ponder. As tech companies struggle to figure out how to monetize AI, and pure-play EV startups just continue to burn through cash in a desperate bid to survive, are highly disciplined, cash-flowing legacy automakers like General Motors actually the smartest investment plays of the 2020s? They took their lumps, they cut their losses, and they aggressively refocused on what works. It is a powerful lesson in capital allocation. Thanks for joining me on this explainer, and I'll see you on the next one.